Okay, picture this. You're scrolling through headlines, maybe thinking about where to put some capital to work, and you see a story about a groundbreaking startup, something genuinely new. You feel that spark, that excitement of backing the next big thing, the potential for life-changing returns. That's the powerful allure of angel investing. But if we're being honest, the flip side is just as real. Most startups don't make it. It's a world defined by incredibly high risk, matched only by the potential for, well, equally outsized rewards. Today, we're taking a deep dive into exactly what that means, what it really takes to be an angel investor right here in the US, pulling the curtain back using the sources you've shared with us.
And the tension you just hit on is crucial. This isn't like buying a blue chip stock or even investing in a mature real estate project. It's personal, it's inherently early stage, and the uncertainty is baked right in. Our mission today is to really walk you through that landscape, who the players are, the mechanics of how individuals step in to fund these, well, nascent ventures, and why, despite the risks, so many are drawn to it.
Absolutely. So let's get right to it. When we talk about angel investing, who are we actually talking about? What defines this role?
Well, at its core, an angel investor is an individual. Someone typically using their own personal money, not managing a large fund for others, to invest directly into businesses at a very early stage. Think seed stage, pre-seed, often before a company has significant revenue or even a fully formed product.
I've heard them called by different names. Are those important? Or just different labels for the same thing?
Mostly just helpful context, yeah. They're also known as business angels, informal investors, angel funders, private investors, or seed investors. The key is that individual personal capital and that early stage focus.
And for putting their own money on the line at this risky stage, what do they usually get in return?
The standard forms are convertible debt or ownership equity. Convertible debt is essentially a loan that converts into equity later, usually during a subsequent funding round, often at a discount to the price paid by those new investors. Equity gives them a direct percentage of ownership in the company right from day one of their investment.
So getting in early is the defining characteristic here, isn't it?
Precisely. Angels often provide crucial support when other, more traditional investors, particularly venture capitalists, simply aren't ready or, frankly, interested yet. This is precisely why the risk of failure is relatively high. The company is just unproven. But, and this is key, it's also why the potential upside, if they do succeed, is so massive. You're getting in right at the ground floor.
And it's not just about the cash, is it? The sources really emphasize that angels often bring much more than capital to the table.
Oh, that's absolutely non-negotiable. Angel investors typically bring valuable expertise gained over their own careers, access to expansive professional networks built over decades, and often provide essential mentorship to the founders. They're not passive check writers. They can be active, strategic partners helping guide the company.
Which makes perfect sense when you consider who many angels are. The sources note they're frequently retired entrepreneurs or senior executives, people who've, well, navigated the business world themselves.
Exactly. And their motivations are often multifaceted. While financial return is certainly a goal, sure, they might also be driven by a desire to stay engaged in a business arena they care about, maybe to mentor the next generation of innovators, or to leverage their accumulated experience and networks in a flexible way. They can offer invaluable feedback, advice, connections. The sources mention that innovation often springs up outside large established organizations, right? And experienced outsiders like angels can be uniquely positioned to help those new ideas flourish.
Okay, so you're an individual, you've got capital and experience, and you're looking for these early stage opportunities. How do companies actually find angels? They aren't exactly listed on the stock market.
Good question. It's primarily through networks and dedicated platforms. Referrals are huge introductions from trusted sources, fellow business contacts, that sort of thing. Angel groups or networks are organized structures where investors pool resources and meet companies. Companies can pitch directly to groups of angels. There are also investor conferences and symposia designed specifically for this kind of early stage matchmaking.
And this angel capital, this early stage funding, it seems to fill a really specific and vital funding gap in the startup ecosystem.
It absolutely does. Think of the typical funding journey. Startups often start with friends and family money, usually smaller amounts, maybe up to a few $100,000 if they're lucky. Then, potentially, they reach out to angels. Beyond that, you have venture capitalists or VCs. VCs typically have much larger minimum investment thresholds, often looking for companies with proven traction, maybe already generating $1 million or more in revenue, and they might not invest anything less than, say, $1 or $2 million. Angels step in before that point. They provide the bridge capital to get the company from that initial friends and family stage to the point where a VC might take notice.
So they fuel that critical early growth.
Got it. And the scale of angel investing in the U.S. is significant compared to VC. It is, surprisingly so in some ways. While VCs manage large pooled funds, angels invest their own funds. But collectively, the total value of angel investments annually in the U.S. is comparable to venture capital. One source points to over $29 billion invested by angels in 2021 alone. And here's a fascinating statistic from older 2010 data. Angels invested in over 60 times more companies than VCs did that year. More recently, in 2021, over 69,000 companies received angel funding in the U.S. This activity has a real economic impact, financing a substantial number of new jobs. Over 274,000 new jobs were financed by angel capital based on 2012 data.
Wow, funding 60 times more companies.
Yeah.
That really highlights how fundamental angels are to getting ideas off the ground across the country. It's not just about the big VC-backed unicorns. It's a much broader base of innovation.
Exactly. It fuels a much wider range of early entrepreneurial activity.
Okay, so we understand what it is, who's involved, and the role it plays. But given that inherent high risk we started with, what are the compelling reasons people actually decide to take the plunge and become an angel investor?
Yeah.
Let's really lean into the reward side now.
Right. The rewards are multifaceted, extending beyond just financial gain for many. One of the primary draws is the opportunity to get deeply involved in exciting, often cutting-edge industries.
Like what? AI, biotech, clean energy, those kinds of things.
Precisely. You can align your investments with areas you're truly passionate about. It gives you a front-row seat to groundbreaking developments that could genuinely shape the future. As a Frensenea is quoted in the sources, angel investing is a great way to get involved with things you're passionate about and, frankly, invest in things you like. It can be a deeply inspiring way to engage with the economy.
That makes sense. You're backing a specific vision, not just a ticker symbol.
Right. Another significant driver is portfolio diversification. Angel investing adds an entirely different asset class, early-stage private companies to your mix, beyond traditional stocks, bonds, or real estate.
How does adding something this risky actually help diversify? That seems a bit counterintuitive.
Well, by spreading your capital across different asset classes, you can potentially reduce overall portfolio risk. If one sector or market segment performs poorly, losses might be offset by gains in another. Startups operate on their own timelines and market dynamics, which may not correlate directly with the broader public stock markets or economic cycles. This lack of correlation can offer a valuable buffer during market downturns.
Okay, diversification is key for managing risk. That makes sense. But let's not bury the lead. The potential for massive return on investment is definitely a major motivator, isn't it?
Oh, absolutely. This is the pure high reward part. If a company you invest in is one of the successful ones, the returns can be truly exponential, far exceeding what you might see in public markets or traditional investments. We're talking potential returns of 5 times, 10 times, even 50 times or more on your initial capital.
That's life-changing potential. But it's not a quick flip, is it? This takes time.
No, definitely not. Patience is mandatory here. The typical timeline from your investment to a potential liquidity event, meaning an acquisition by a larger company or maybe an IPO, is often 3, 5, 7 years, sometimes even up to 10 years or longer. But getting in early means you participate in that potential exponential growth over that time horizon.
So high reward, but you have to wait for it. Understood. Beyond your personal portfolio, there's a broader impact to consider too, right?
Absolutely. Supporting innovation and economic growth. By funding these startups, you are directly enabling entrepreneurs to develop new technologies, products, and services that wouldn't otherwise see the light of day. You're helping bring groundbreaking ideas to market, which in turn creates jobs and stimulates broader economic activity. The Kauffman Foundation's work consistently highlights that virtually all net new jobs in the U.S. are created by companies under 5 years old. Angel investors are literally funding the companies that are the engines of future job creation.
That's a powerful way to think about the impact. And you're not just writing checks in isolation, you're often building relationships and a network.
Definitely. Becoming an angel investor immerses you in a vibrant ecosystem. It's a fantastic way to connect with brilliant, driven entrepreneurs, fellow experienced investors, and industry experts. This network is invaluable. It can help you identify future opportunities, share knowledge, collaborate on deals, and provides a community of support. Being part of that community keeps you sharp and informed on the latest trends.
It sounds like a community of shared learning and action almost.
Precisely. And for those with significant professional experience, it also offers a compelling opportunity to become a mentor.
Guiding the founders of the companies you've backed, using your own experience.
Exactly. Your hard-won experience, knowledge, and connections can be absolutely invaluable to a startup founder navigating the complex challenges of building and scaling a business. Mentoring can be incredibly rewarding personally, knowing you're directly contributing to a company's success and helping develop the next generation of business leaders.
And unlike investing in a mutual fund, or even some private equity, you often have direct control over your specific investments, which must be appealing.
That's a big appeal for many. Angel investing gives you the freedom to make truly independent investment decisions. You can choose startups based on criteria that matter most to you, your personal values, goals, and vision for the future. You're not bound by the potentially stricter guidelines or investment mandates of larger institutional investors.
And I bet evaluating these diverse startups constantly sharpens your own business acumen, keeps you on your toes.
Without a doubt. Evaluating business plans, assessing markets, tracking trends, analyzing financial models, judging management teams it requires, and continuously develops critical thinking, expertise in investment strategies, a deeper understanding of entrepreneurship, and insight into innovation. It makes you a more capable investor across the board.
You mentioned angel groups and syndicates earlier. Is that part of investing alongside others? How does that work?
Yes, and it's a major advantage. You certainly don't have to invest alone. Joining a group or syndicate allows you to pool resources, knowledge, and expertise with other experienced angels.
How does that help? What are the benefits?
Well, you can participate in larger deals than you might afford individually. It facilitates diversification because you can access deals sourced by others in the group. Critically, it allows for shared due diligence, multiple experienced eyes reviewing an opportunity, provides deeper insights, and spreads the workload, which can be significant. You also gain access to the combined network and connections of the entire group, which is immensely valuable during due diligence and for supporting portfolio companies later on. It significantly reduces individual risk and effort.
Sharing the load, sharing the insights, sharing the network, that makes a lot of sense. Now let's talk about something quite specific to the U.S. context that can make angel investing significantly more attractive. Tax relief benefits.
Ah, yes. These are powerful incentives built into the U.S. tax code specifically for investing in qualifying small businesses. They can dramatically impact the potential net return, especially considering the high risk of failure we've talked about.
Okay, what are the key provisions we should know about here?
There's Section 1202, often referred to as the Qualified Small Business Stock, or QSBS exclusion. This provision can allow for a partial or even full exemption from federal capital gains tax when you sell stock in a qualifying small business.
That sounds incredible, a full tax exemption. What are the hoops you have to jump through?
There are specific requirements, yeah. First, you must have acquired the stock directly from the company upon its original issuance, not bought it from a previous owner. The company must be a domestic C corporation, and importantly, its gross assets must have been $50 million or less at the time you acquired the stock and immediately after. The company must use at least 80% of its assets in the active conduct of a qualified trade or business. And critically, you must hold the stock for at least 5 years before you sell it.
Okay, so invest early in a relatively small active C corp and hold for 5 years. Simple enough on paper. And is there a limit to the gain you can exclude?
Yes, there is a limitation. The maximum gain you can exclude per company is the greater of 10 times your basis in the stock, or $10 million. Any gain above that amount is typically subject to standard capital gains tax.
Got it. 5 years is a significant holding period, especially in the volatile world of startups. What if a great exit opportunity arises before 5 years are up? Are you just out of luck on the tax break?
That's where Section 1045 comes into play, the QSBS rollover provision. If you sell QSBS stock that you've held for at least 6 months but haven't reached the 5-year mark yet, you can potentially defer paying the tax on that gain. Now, by reinvesting the proceeds into another qualified small business stock within 60 days of the sale, this effectively allows you to roll your gain into a new QSBS investment, keeping the clock running, so to speak, helping you achieve the 5-year holding period needed for the Section 1202 exclusion with that new stock.
So you can potentially chain these investments together, deferring tax until you hit the 5-year mark on a subsequent successful QSBS investment. That's a powerful mechanism for recycling capital and managing your tax liability.
It is, and it definitely encourages reinvestment back into the startup ecosystem. Now, let's consider the downside protection, which is crucial given the high failure rate. This is addressed by Section 1244.
Okay, Section 1244. How does that help when an investment inevitably fails?
It allows you to treat capital losses on the first $1 million you invest in a qualifying company as ordinary income loss, rather than just a standard capital loss.
Why is treating it as ordinary income loss beneficial? What's the practical difference?
Because ordinary income is typically taxed at higher rates than capital gains. Furthermore, standard capital losses can generally only offset capital gains, plus a maximum of $3,000 of ordinary income per year. An ordinary loss under Section 1244 can offset a much larger amount of your ordinary income, think salary, business income, effectively reducing your tax bill on that income.
So if an investment goes to zero, this provision can significantly cushion the blow by lowering your taxable income from other sources, potentially saving you quite a bit at tax time depending on your bracket.
Exactly. It's a significant tax shield against the inevitable failures in an angel portfolio. And the $1 million threshold for this ordinary loss treatment applies per company, which comfortably covers most typical angel-sized investments. The sources provided a useful example showing how it works. Imagine you have $100,000 in ordinary income and make two $10,000 investments in qualifying companies. One fails, $10,000 loss, and the other is a home run, returning $50,000 on your $10,000 investment, so a $40,000 gain.
Okay, walk me through the tax impact there, with and without 1244.
All right, using the source's logic. Without Section 1244, that $10,000 loss is a capital loss. Let's say it can only offset $3,000 of your ordinary income in that year, the standard limit. So your taxable ordinary income is $97,000. You also have the $40,000 capital gain from the winner. You'd pay ordinary income tax on the $97K and capital gains tax on the $40K.
Okay, but with Section 1244 applying to the $10,000 loss.
That $10,000 loss becomes an ordinary loss. It directly reduces your taxable ordinary income. So your taxable ordinary income becomes $100,000 minus the full $10,000, which is $90,000. You still have the $40,000 capital gain taxed at the capital gains rate. The key difference is that the full $10,000 loss reduces your higher taxed ordinary income, rather than being mostly limited to offsetting capital gains or just $3K of ordinary income. This generally results in a lower overall tax bill.
Got it. So the real benefit comes from offsetting that high tax rate ordinary income fully, which is much better than the standard capital loss limitations.
Exactly. The specific numbers depend on tax rates, but the principle holds Section 1244 provides a significantly better tax outcome for failed investments compared to standard capital loss rules.
Yeah, that clarifies the benefit. What about investing through syndicates or SPVs? How do these tax benefits work then? Does the structure get in the way?
Good question. When you invest through an SPV, special purpose vehicle, which is often structured as an LLC or LP, it's typically designed to be a pass-through entity for tax purposes. This means the gains and losses generated by the underlying startup investment are passed through directly to you, the individual investor, and reported on your personal tax return, usually via a K-1 form. As long as the startup you invested in through the SPV is a qualifying QSBS C Corp, you should still be eligible to claim the benefits of Sections 1202, 1045, and 1244 as an individual investor.
So the SPV structure doesn't negate the individual tax benefits?
Not usually if structured correctly and the underlying company qualifies. That's key. It's worth noting, though, that if the SPV invested using convertible notes that accrue interest before converting to equity, you could potentially have taxable interest income passed through to you via that K-1 before any equity gain occurs. That's something to watch out for.
Oh, okay. And I hear simple agreements for future equity are more common now than convertible notes sometimes. Do they have that interest issue?
Right. SAFEs have become very popular. They generally don't accrue interest like traditional notes, which can simplify things from an early tax perspective, avoiding those potential taxable interest events before conversion. They basically defer the valuation discussion until a later priced round.
This all sounds complex, but clearly very advantageous. What about record keeping? This seems like something you really need to track carefully.
Absolutely crucial. You need meticulous records. That includes keeping all K-1s from SPVs, even in years with no reported income or loss. You need documentation proving the startup qualified for Sections 1202, 1045, and 1244 when you invested, things like financial statements showing assets were under $50, proof it was a C Corp, etc. You need to track your holding periods religiously for Section 1202 and 1045. And if you invested via convertible notes, track any potential interest income. Tax laws change too, so staying aware of updates is also important.
And the essential final step.
The big disclaimer.
Right.
Always consult with a certified tax counsel or CPA who specializes in these areas before filing your annual taxes. This information is for educational purposes. Your personal tax situation is unique and requires professional advice. Don't rely just on us.
So these U.S. tax incentives are not just theoretical. They're substantial benefits that are a real part of the investment calculation for angels. Okay, we've covered the rewards and the tax advantages. Now, who actually gets to participate in this game? There's a barrier to entry, a gatekeeper in the U.S., right? The accredited investor rule?
Yes, there is. Due to the inherent risks and lack of public registration for these types of investments, the Securities and Exchange Commission, the SEC, under Regulation D, restricts participation in certain private securities offerings like startup equity or debt to what are known as accredited investors.
Why that restriction? What's the rationale behind it?
The primary reason stated is investor protection. These investments aren't registered with the SEC, meaning they don't have the same detailed public disclosure requirements as stocks traded on major exchanges. They're considered inherently riskier and, frankly, less transparent. The SEC's view is that accredited investors are typically financially sophisticated individuals or entities who are presumed to have the knowledge and financial capacity to understand these risks and bear the potential loss of their entire investment without needing the standard regulatory protections afforded to the general public.
So it's meant to shield less experienced or less affluent investors from highly speculative and potentially opaque ventures.
Precisely. Though, as one source points out, it also has the effect of concentrating investment opportunities in private markets among those with substantial financial assets, creating a distinct tier of investors, which is a whole other discussion, really.
Fair point. So how does an individual actually qualify as an accredited investor in the U.S.? What are the specific criteria?
The most common ways to qualify are through either an income test or a net worth test.
Let's break down the income test first.
Okay. For an individual, you must have had an annual income exceeding $200,000 for each of the 2 most recent years. If you're married or have a domestic partner, the combined income threshold is $300,000 for each of the 2 most recent years. Crucially, you must also have a reasonable expectation of reaching the same or a higher income level in the current year. And the rules clarify you can't mix individual income from one year with joint income from another to meet the 2-year look-back. It has to be consistently above the threshold for the relevant filing status over those 2 years.
Okay, a consistent high income stream. What about the net worth test?
This is about your total assets minus liabilities. Your net worth must exceed $1 million, either individually or jointly with your spouse or partner. A very important detail here. This calculation specifically excludes the value of your primary residence.
So you calculate assets, subtract liabilities, but don't count your home's value towards that $1 million threshold. If someone has a home with $500 and other net assets of $1,110, they qualify because the $1,110 is over $1 excluding the home. But if their total net worth, including the home, is $1,200, but other net assets are only $900, they don't qualify under this test.
Exactly. The exclusion of the primary residence is key for the net worth test. That catches some people out.
Are there any other ways to qualify beyond just income and net worth? Has that changed?
Yes. The definition of accredited investor was broadened in 2020 to include individuals based on certain professional knowledge or certifications, recognizing that financial sophistication isn't solely tied to wealth. Examples mentioned include holding specific M&RA licenses like the Series 7, 65, or 82. Also, certain knowledgeable employees of a private fund can qualify based on their role within that fund.
So demonstrating financial expertise through credentials or specific job roles can also open the door now.
Right. It acknowledges different paths to financial sophistication. Entities can also qualify in several ways, like certain trusts or organizations with assets over $5 million, or entities where all the individual equity owners are themselves accredited investors. However, an entity cannot be formed solely for the purpose of buying specific securities. That's an important anti-abuse rule. Also, general partners, executive officers, or directors of the company issuing the securities automatically qualify based on their direct involvement with the offering.
Okay, so you meet one of these criteria. How do you actually prove you're accredited? Do you get a card from the SEC or something?
No, you don't get a certificate from the SEC. The burden of verifying that an investor is accredited actually falls on the company that is offering the private securities.
Ah, so the startup has to check. How do they typically do that verification?
Companies will require potential investors to provide documentation. This could involve providing copies of tax returns, like Form 1040, or W-2s to verify income. For the net worth test, you might need to provide bank statements, brokerage statements, or other documents detailing assets and liabilities. Alternatively, companies often accept a letter from a qualified professional, like a licensed CPA, an attorney, or a registered broker-dealer, confirming that they have reviewed your financials and verified you meet the criteria. Sometimes a credit check might be used as part of the net worth verification process.
So it's a process driven by the company raising money, where you provide evidence to them or maybe a third party they hire.
Correct. And as the source notes, for individuals holding certain professional designations or those who are known managers of funds, the verification process might be simpler as their accredited status is more easily confirmed through public records or industry databases. They might not have to jump through the same hoops every single time.
So that's the necessary gateway to participate in this market. It serves a regulatory purpose, but clearly creates a divide based on financial status or specific professional qualifications.
That's the fundamental structure of this market under current U.S. law. It is what it is for now.
All right, let's say you've cleared the accredited investor hurdle. You have the capital, you've got the green light to play. But before you even think about writing a check, there's a critical phase. This brings us to the absolute heart of smart angel investing: due diligence, or DD.
Yes, this is where the real work and, frankly, the fun of the investigation begins. Due diligence, or DD, is the comprehensive investigation and analysis an investor performs to determine if a potential investment opportunity is legitimate, viable, and, crucially, meets their specific investment criteria.
And the core objective: why go through all that effort?
To identify and mitigate investment risk. Simple as that. You need to deeply understand the company, its market, its team, its financials, and whether it aligns with what you're looking for in your portfolio.
The sources stress that DDD is even more important for angels than it is for, say, venture capitalists. Why is that added emphasis there?
Because angels are typically investing at the earliest stages seed, sometimes even just an idea and a team, you know. At this stage, the company is the most fragile, the business model the least proven, and the risk of catastrophic failure is highest. VCs usually invest later when there's more data, more traction, and many of the initial risks have hopefully been reduced or at least better understood. Angels are often the first outside money in, facing the steepest part of the risk curve, so their diligence needs to be exceptionally thorough relative to the limited information available.
That risk identification is key. The sources use a compelling example with probabilities to illustrate how risks compound. Can you walk me through that?
They do. It's quite powerful. If you have, say, 7 critical factors that must succeed for a startup to work, maybe hitting a product development milestone, securing a key partnership, achieving a specific sales target, overcoming a regulatory hurdle, things like that. And even if you're relatively optimistic, giving each factor a 90% probability of success.
Okay, that sounds pretty good individually. 90% success rate on each factor.
On its own, yeah. But the probability of all 7 succeeding is the product of their individual probabilities. 0.9 times 0.9 times 0.9, 7 times. That works out to just under 48% overall probability of success for the venture.
Wow. So even with seemingly high individual chances, the collective probability of everything working out is less than half.
Exactly. And the example goes on to show that if just one of those critical factors has a lower probability, say only a 50% success likelihood, while the other 6 are still at 90%, the overall probability of success for the venture plummets to about 27%. This illustrates powerfully why you must identify and try to minimize as many of these risks as possible through due diligence. Each unaddressed risk significantly erodes the chances of a successful outcome.
That really puts the compounding nature of risk into perspective.
Yeah.
And there are a lot of potential risk areas to look at. The team, the market, the technology, competition, finances, even legal issues.
Precisely, all of those. And failing to uncover issues can be disastrous. The sources mention the cautionary tale of hitsgalore.com, a company whose valuation crashed after it was revealed that a founder had a history of cheating customers at a previous job information that supposedly wasn't fully disclosed. Had that come out during thorough due diligence, investors could have avoided that loss entirely. It highlights that founder integrity, even past behavior, is absolutely paramount.
So when should you start this rigorous DD process? You can't do it for every company you see.
No, absolutely not. The timing is crucial. First, you need clear investment criteria. What kinds of companies, industries, or milestones are you even looking for? Don't start DD on everything that crosses your desk. Second, before you even dive deep, you need a strong gut feeling about the management team. This is emphasized repeatedly in the sources. If you don't feel comfortable with them, if there's any sense of mistrust or lack of integrity, that's a deal breaker right there. Don't proceed no matter how good the idea looks on paper.
Trust in the founders is non-negotiable from the get-go.
Absolutely. Friction with or lack of confidence in the leadership is a recipe for disaster at the early stage. You also need to be selective. If you're part of an angel group, you probably can't effectively do deep dives on more than 1 or 2 deals per month. Trying to do too many means spreading your resources too thin and likely missing critical issues. It helps enormously to have members within your group who have relevant domain expertise to lead the due diligence for a specific company. Leverage that expertise.
Okay, once you've picked a promising deal and you trust the team initially, how do you structure the DD? What's the plan? What do you look for?
You start by identifying the absolute key assumptions the business is making that must be validated for the investment to be sound. This involves drilling down into specific areas. For instance, evaluating the viability of their intellectual property, IP.
What are the common pitfalls there? What can go wrong with IP?
Well, the sources mention issues like patents being filed too late after the idea was publicly disclosed, potentially making them invalid, or the scope of patent claims being too narrow, allowing competitors to easily design around them, or the company having potential exposure to lawsuits for infringing on other companies' existing patents. You need to understand the strength and defensibility of their IP moat, if they even have one.
And verifying actual market demand is critical, I assume, not just build it and they will come.
Oh, absolutely vital. Does the product or service solve a real problem for customers? A genuine pain point. Avoid ideas that just seem cool or that you think customers should want, but don't address an urgent need. The application of the product needs to be obvious and compelling to the target user. And critically, do those customers have both the willingness and the ability to pay? If your ideal customer base can't afford it, it doesn't matter how much they like it.
Proving the market exists and is large enough, that sounds challenging, especially early on.
It requires rigorous market analysis. It's often not about pulling one number. It's a process of research and refinement. The source provides an example of trying to size the market for business tools for independent musicians. Early broad estimates from tax data and MySpace profiles were wildly inconsistent, but digging deeper and finding a comparable, like CD Baby with 100,000 users, provided a much more realistic estimate of potential users. Sometimes this might involve expensive professional market research firms, but angel groups often rely on leveraging their collective industry knowledge and network.
And confirming they actually have customers or solid leads, not just hypotheticals.
Essential. A red flag is a startup claiming vast potential customers but having 0 paying users, or even strong letters of intent. The sources highlight that having just 2 established, reputable customers who confirm they are actively buying or genuinely plan to buy the product is a significant validation hurdle cleared during DoD. That's a good sign.
So identifying key assumptions to confirm, like IP, demand, market size, customer relationships. But BD also involves distinguishing between acceptable risks and outright deal breakers, right?
Exactly. Some risks are inherent in early stage investing. Maybe the technology is cutting edge and there's a risk it won't work perfectly or won't work on schedule. These are risks you might decide are acceptable to take if the potential reward is high enough and other factors are strong. Ruling out every deal with technical or market uncertainty would mean missing most potential home runs.
But there are non-negotiables, things that automatically kill the deal no matter what.
Absolutely. And it's important to define these deal breakers up front, maybe even write them down for your group. The lack of integrity in management, as we discussed, is the most common and critical one. If you uncover dishonesty, a questionable past, or a fundamental lack of trustworthiness, you should walk away, full stop. No amount of market potential or clever technology can compensate for bad founders.
Due diligence sounds resource intensive. Are there significant costs involved?
Yes, it can be. There are potential legal costs for reviewing corporate documents, IP filings, and investment agreements, though using standardized legal templates can help manage this. You might pay industry experts for technical evaluations or market assessments, which can run into the thousands. Site visits and travel expenses to meet the team, visit facilities, or talk to customers can also add up. You need to budget for these costs as part of the investment process.
Speaking of legal documents, entrepreneurs often want investors to sign non-disclosure agreements, NDAs, before sharing detailed information. How do angels typically approach NDAs?
Ah, the NDA question. It's a point of some discussion, and many experienced angels are reluctant to sign broad, blanket NDAs early in the process. Investors see a high volume of potential deals, right? And signing NDAs for everything creates significant potential legal exposure if they later invest in a similar company that they saw through a different channel. Plus, as one investor viewpoint suggests, while ideas are important, execution is often the truly differentiating factor. Ideas are often less unique than founders think.
So the idea needs to stand on its own merits initially without needing an NDA for the first look.
Generally, yes. For genuinely sensitive, truly proprietary information like detailed source code, chemical formulas, or patentable specifics, a more narrowly scoped NDA might be possible after an investor has expressed serious interest and done some initial vetting. But signing a broad NDA just to view an initial business plan is often a non-starter for experienced angel investors. It's always wise to consult a lawyer on any NDA, from both sides.
Okay, so you're in the thick of due diligence, asking hard questions, digging into the details. Based on what you uncover, what are the most common reasons that deals ultimately get rejected? What are the biggest red flags that pop up?
The sources are unequivocal on this. The number one reason deals fail DD or are rejected by angels is the management team. It's the single most critical factor.
Okay, so what specific issues do you look for in management? What trips them up?
You're evaluating their credentials, their experience, their track record. Do they have the necessary skills to build this specific business? Background checks are important, looking into any past lawsuits, bankruptcies, criminal convictions, or tax issues. Anything that suggests lack of judgment or integrity. Their mindset is crucial. Are they truly driven by the massive opportunity to build a great company? Or are they motivated by personal reasons, like wanting to escape a bad job or simply prove someone wrong? The sources quote David and Laura Gladstone on this, emphasizing that investors aren't therapists there to solve the entrepreneur's personal problems. The motivation should be mutual gain from the business opportunity.
Resilience and ability to handle pressure must be important too, given the startup roller coaster.
Oh, absolutely. Building a startup is incredibly demanding. Long hours, constant stress, setbacks. Founders need the physical and mental stamina to handle that grinding pace. Leadership ability is key. Can the CEO inspire confidence in employees, partners, and future investors? If they can't motivate employees who have less at stake than you do as an angel investor, that's a huge problem.
And back to integrity. Seems like the most important one.
Yes, honesty and integrity are paramount. This is where anecdotes like the hitsgalore.com founder or the founder who hired someone just to look busy during a site visit come in. If you find any evidence of dishonesty, misrepresentation, or lack of integrity, the unanimous advice is to run, not walk, away. You are partnering with these people for potentially many years. Trust is absolutely non-negotiable.
Intelligence and adaptability seem vital, given the pivots startups often need to make.
They are. Startups rarely follow the initial plan perfectly. Management needs the intelligence to analyze new information and the flexibility to pivot when necessary without ego getting in the way. Good judgment is also crucial, especially in early hires. The anecdote about the founder hiring her unqualified husband as head of marketing, who disliked travel in a sales-focused role, is a perfect example of poor judgment uncovered during DD that raised serious concerns, just bad decision-making.
Those examples really bring home the importance of scrutinizing the people running the show. What about market and competitive risks? Are those common deal breakers too?
Also, major reasons for rejection, yes. Market size analysis, as we discussed, needs to be rigorous and grounded in defensible assumptions, not just citing huge top-down numbers without a credible bottom-up build. You need a deep understanding of market dynamics, customer behavior, distribution channels, pricing sensitivity, and a concrete revenue model that makes sense. Thoroughly understanding the competition is essential, not just listing competitors, but analyzing their market share, financial health, strengths, weaknesses, and how your company's proposed solution truly differentiates itself and why customers would switch.
How important is competitive advantage? Is being first to market enough?
Being first can be an advantage, sure, But the sources suggest it's usually not a sustainable competitive advantage on its own unless you use that head start to build durable barriers to entry very quickly. What really matters is a sustainable competitive advantage, whether it's proprietary know-how, like unique tech or IP, powerful network effects like social media or marketplaces where value increases with users, high switching costs for customers, long-term contracts, or control over key distribution channels. Without a sustainable moat, competitors will likely replicate your offering sooner or later.
Okay, so strong management, defensible market position. What about issues with the business model itself? When does that kill a deal?
Well, the business model must create economic value for both the company and its customers. If customers don't see the value proposition, they won't buy or won't stick around. Simple as that. The distribution plan is critical. How will they actually acquire those first customers and then scale that acquisition efficiently? Differentiation is key. Very few ventures succeed solely on being the lowest cost provider, especially early on. And growth strategy can hide problems, right?
How so? Isn't growth good?
It is, but founders need a realistic growth strategy that considers the cash flow implications. Companies can literally grow themselves to death by running out of working capital needed to fund rapid expansion before revenue catches up. A thorough cash flow analysis is vital. From an investor perspective, business models with recurring revenue streams are generally more attractive as they provide predictability and higher terminal value. Capital requirements need to be realistic too.
Meaning how much they need now and later.
Exactly. They need to be realistic about how much capital they need now and their ability to raise future rounds. Is there enough equity allocated to founders, employees, via option pools and angels now, to leave enough room for significant future VC rounds without excessive dilution for everyone? The investment deal structure needs to be fair, motivating for the founders, and provide sufficient potential return for the angels given the risk. And finally, the exit strategy. You must have a plausible plan for a liquidity event. How will investors eventually get their money back, hopefully with a good return?
What are the typical exit paths?
Is it acquisition? They should identify potential buyers and explain why those buyers would acquire the company, referencing comparable M&A deals if possible. Is it an IPO? Are there comparable public companies? Probably less likely for most angel deals, but possible. Or perhaps a buyout from the company's own cash flow is mentioned as a possibility, though this is less common for VC-tracked companies. But the key is a clear path to getting your capital and returns out of the illiquid private company eventually.
If there's no foreseeable way to get your money out, it's not really an investment you can realize a return on. The Web van anecdote about trying to scale a low-margin grocery delivery business seems relevant here too. Bad model from the start.
Absolutely. That's a classic example demonstrating that you cannot overcome a fundamentally poor business model with slim margins through sheer scale or marketing spend. Profitability, or at least a clear path to it at scale, is non-negotiable.
Okay, what about the financial projections themselves? These often look like hockey sticks going straight up and to the right. How do you assess those?
Yes, and that's often a red flag, if not well supported. Projections must be based on realistic, defensible assumptions. The example of a company selling to the government projecting 2-month sales cycles is unrealistic. Government sales typically take 6-12 months or much longer. Founders can't just hand-wave achieving market share. They need to explain how they will reach those sales numbers, specific customer acquisition costs, conversion rates, sales cycles, distribution plans. Overly aggressive, unsubstantiated growth projections instantly undermine credibility.
Management salaries and expenses also come under scrutiny during D&D.
Definitely. Founders need to earn a living, sure, but their salaries shouldn't be exorbitant, especially in the early stages before significant revenue. The sources present differing views here. Some suggest a reasonable salary is okay, maybe $100 a year for a seasoned founder at pre-revenue stage was mentioned as acceptable by one investor. Others feel investment money should not primarily fund founder salaries. The underlying idea is that founders should have more skin in the game than the angels, primarily betting on the equity upside, not extracting significant cash via salary before the company is profitable or sustainable. Reasonable operating expenses are expected, but luxury perks funded by investor money are typically a deal breaker. Optics matter.
And the balance sheet. What are you looking for there?
Angels want to see that the founders have skin in the game, often by having invested their own funds or friends and family money in earlier rounds. Assets need to be valued appropriately. Liabilities should be clean. Avoid companies with significant murky debt or unusual obligations. If founders have personally loaned money to the company, they should generally be willing to convert that debt to equity as part of the investment round. Finally, Management needs a solid plan for cash flow management, understanding their burn rate, how fast they're spending cash, and having a clear plan for extending their cash runway and raising subsequent rounds of capital based on realistic timelines. Running out of cash is the ultimate failure.
That's an incredibly thorough list of areas to examine. Can you summarize the typical steps in the due diligence process itself? How does it usually flow?
It generally starts with a deep dive into the written business plan, analyzing the vision, the business model, market analysis, marketing strategy, and financials. That usually leads to site visits, if applicable.
Like getting on the ground, seeing things firsthand.
Exactly. Visiting the office, lab, or facility if they have one. This gives you a general impression of the culture, the setup, and allows you to interact with employees, though. As the anecdote about the hired lady pretending to be busy shows, be aware management might try to stage things. Sometimes, a few minutes talking to employees before the main meeting can provide crucial, unfiltered insights, and follow up on anything that looks conspicuous, like asking about empty space in a factory, as Catherine Mott's story illustrates. Don't be afraid to ask.
Observation and asking potentially awkward questions seem key during visits. What happens after that?
Reference checks are absolutely crucial. Beyond the references the company provides, which will obviously be positive, you must conduct independent reference checks. Leverage your network. Platforms like LinkedIn are great for this, to find people who know the management team, past employees, advisors, customers, even competitors. One investor mentioned aiming for around 30 conversations, asking each reference for additional names to get a fuller picture, sometimes going 3 layers deep. Another powerful anecdote involved leveraging a personal connection who happened to be suing the founder to uncover serious integrity issues that were not initially disclosed. You never know where the key info will come from.
Leveraging your personal and group network is incredibly valuable here. It's not just about reading documents.
It's an indispensable asset in early-stage DD. After gathering all this information from the plan review, site visits, and reference checks, you revisit the original business plan. Does everything you've learned validate the key assumptions? Do the financials still seem plausible based on market reality and team capability? You reevaluate the competitive landscape and the proposed capital structure based on your findings.
There seems to be a debate about how much DD is enough. How deep should you go? Is there a point of diminishing returns?
That's a fair point. And there's no single universal answer. Some investors spend months commissioning detailed reports. Others make decisions relatively quickly based on experience and pattern recognition. Interestingly, some research has suggested no proven correlation between the length of the due diligence process and the eventual success or failure rate of the investment.
So spending more time doesn't automatically mean a better outcome. That's surprising.
Not necessarily. The depth of analysis should ideally be proportionate to the stage and complexity of the deal. Later stage deals, closer to VC investments, usually warrant more formal, extensive analysis. Earlier angel stage deals might rely more heavily on the collective wisdom and experience of the angel group members, focusing on key deal breakers and team assessment. The ability to make quicker decisions based on judgment and key red flags can actually be an advantage angels have over larger, more bureaucratic VC funds. Ultimately, you need to find the balance that works for you and your group, remaining flexible but disciplined. Know yourself.
D&D is hard, complex work. The sources suggest standardization could make it more efficient. What's the idea there?
Yes, the idea is that sharing best practices, perhaps standardizing some of the legal documentation like term sheets or the DD checklist itself across the angel community, could streamline the process, reduce redundant effort for both investors and entrepreneurs, and potentially improve the quality of diligence across the board. More collaboration.
So, rigorous due diligence, with an intense focus on the integrity and capability of the management team, is the cornerstone of navigating the high risks. But even with the best DD, angels can still make mistakes. Let's look at some common pitfalls to actively avoid, even after you decide to invest.
Right. Moving from the process itself to the common traps investors fall into, even after they've done their homework and deployed capital, the sources highlight several key ones. The first is arguably the most critical: lack of sufficient portfolio diversification.
This comes right back to the high risk we started with, doesn't it?
It does. Angel investing is not about picking individual winners with certainty. Nobody can do that consistently. Success in this asset class is fundamentally based on having a portfolio of investments. Many, probably most, will fail or return very little. Risk mitigation absolutely requires spreading your capital across multiple companies. Experts strongly recommend investing in at least 10 to 12 companies, and ideally expanding to 20 startups or more over time.
Why such a high number? That sounds like a lot of work and capital.
Because the returns in angel investing typically follow a power law distribution. The vast majority of your total return will likely come from just one or two home run investments within your portfolio, which need to cover the losses from the many failures and provide the overall profit. A small portfolio of only, say, 3 or 4 deals is extremely risky because the probability of one of those specific few being a massive home run is very low. You need enough swings at bat to increase your chances of catching those rare breakout successes that drive portfolio-level returns.
So resisting the urge to put too much money into a single exciting deal, no matter how convinced you are at the time.
Which leads directly to the second common mistake: allowing for significant disparity in investment amounts based on your conviction level in a specific startup. It's really tempting to write a much larger check for the one you feel most passionate about, the one you think is the one.
But that's a mistake. Why not bet bigger on your best ideas?
The advice from experienced angels generally is to adopt a more consistent approach and invest roughly the same amount, or within a defined range, in each deal that passes your due diligence criteria. This simplifies your strategy, prevents overexposure to any single unproven venture. Remember, even your highest conviction deal could fail for unforeseen reasons, and maintains a balanced portfolio where any single failure doesn't sink your overall performance. Discipline is key.
Discipline over emotion. Makes sense. What's the third pitfall?
Succumbing to founder bias. It's natural to gravitate towards entrepreneurs you like personally, who maybe remind you of yourself or who come from a similar background or alma mater. But letting these personal connections or unconscious biases overly influence your investment decision, rather than focusing on the objective merits of the business itself, can lead to poor choices.
Like overlooking red flags because you have good rapport with the person, or you went to the same school.
Exactly. Or, conversely, passing on a potentially fantastic opportunity because the founder's personality doesn't immediately click with yours, even though the business fundamentals are sound. You need to evaluate startups based on market potential, product viability, team execution capabilities, and competitive landscape, guarding against allowing personal preferences or affinity bias to cloud your judgment. Focus on the opportunity.
Focus on the business opportunity, not just the personality fit. Got it.
Right. The final common mistake highlighted in the sources is neglecting continuous learning.
The idea of angel investing as a second career, requiring ongoing education.
Precisely. Many successful business people transition into angel investing, assuming their past experience is sufficient. But the startup world is incredibly dynamic. It changes fast. New technologies emerge constantly. Market trends shift rapidly. Investment structures evolve, like the rise of safety we mentioned. You must actively prioritize self-learning, attending industry events, networking with other investors and entrepreneurs, taking relevant courses, reading blogs and research to stay informed and make intelligent, current decisions.
So you can't just rest on your laurels or past expertise. You have to actively educate yourself about the current startup landscape and investing practices.
Absolutely. It requires a commitment to being a continuous learner in a fast-moving field. What worked 5 years ago might not be the best approach today.
Those are 4 critical traps to avoid: insufficient diversification, inconsistent check sizes, founder bias, and neglecting continuous learning. They all require discipline and a strategic, almost professional approach.
They really do. Avoiding these significantly increases your chances of achieving success at the portfolio level over the long term.
This has been a truly deep dive into the world of angel investing in the U.S. We've really unpacked what it is individuals providing crucial, early-stage capital, often bringing more than just money, filling that vital gap between friends and family and VC funding.
We've explored the compelling rewards, the chance to get involved in exciting industries, diversify your portfolio, the potential for massive financial returns, the opportunity to support innovation and job growth, build a powerful network, and mentor the next generation. And we've highlighted the significant U.S. tax incentives like the QSBS exclusion and Section 1244 ordinary loss treatment that can really buffer the downside and enhance the upside if you qualify and document properly.
But we've also clearly laid out the gatekeepers, the accredited investor requirement, designed, at least in theory, to protect less sophisticated investors, but also creating a distinct tier in the market. And we've delved deeply into the absolutely critical role of rigorous due diligence, particularly focusing on the integrity and capability of the management team, alongside evaluating the market, the business model, the financials, and managing risk. It's a lot of work.
And finally, we've looked at the key pitfalls to avoid underscoring that success is portfolio-based, requiring significant diversification, disciplined investment amounts, objective evaluation of founders, and a commitment to lifelong learning in this dynamic space.
The potential rewards in angel investing are undeniably significant, offering a chance to back the future and potentially see substantial returns. But success isn't guaranteed on any single investment. It truly requires patience, discipline, strategic portfolio building, and continuous education. It's a serious endeavor, not really a casual hobby if you want good results.
Yeah, it's much more than just having the capital. It's about applying strategic thinking, doing the hard homework, and committing to being actively engaged in the ecosystem.
So here's a final thought for you to chew on as we wrap up. Angel investing isn't just about personal financial gain, though that's obviously a driver. By providing that critical early fuel, angels play a fundamental role in shaping future industries, bringing new technologies to life, and creating the jobs of tomorrow. Beyond the potential returns, what role do you want to play in being part of that ecosystem? What does it mean to you to be an active participant in bringing groundbreaking ideas into the world?
It offers a unique blend of financial potential and tangible impact, a chance to not just invest in the future, but maybe help build it just a little bit. It's quite compelling when you frame it that way.